Welcome to Lesson 39, T3 Lesson 6, Trade Journal and Review. This is what often separates pros from amateurs. What you'll learn today: why your brain misremembers trades, a concrete way to spot patterns in your trade, log the 5 must-write items in a real journal. Without records, only emotion remains, and when emotion remains, the same mistakes repeat. But as the log stacks up, your real trading ability comes into view. Raise a hand if you can clearly recall a trade from 3 months ago. Drop in the comments too if you want. Your brain is lazy in a useful way. Winning trades stick large. Losing trades get pushed aside fast. Psychologists call that confirmation bias. A plus 2% to winner 3 months later still feels like I exited exactly at that level, while minus 1.5 to stop a week later blurs into a I was just weak that day. Entry reason, target, why you stopped out. After about a month, most of it is gone. Same as forgetting last week's coffee price. Every time cafe prices creep up, $3 becomes $4.50 and you barely notice. So write it down right after the trade. A note written while the emotion is hot is 100 times more honest than what your brain remembers a month later. Even 5 lines on why this candle matters now keep you steadier when the same signal shows up again. No journal, no pattern. No pattern, no evolution. Your growth scales with how deep the record goes. Pull your last 20 trades and stack only the losers. Patterns show up. Things like I fail when I enter on the close after a choppy 4-hour candle swings both ways, or entries in the 30 minutes before a Fed or big eye news print get emotional stops about 90% of the time. Seeing that pattern at least 3 times is when the insight lands. I'm weak on this signal. My rules aren't filtering this well. Once the pattern is clear, do one of 2 things next time. Add a stricter extra check when that signal appears, or skip it entirely. Both improve the path to better results. 100 YouTube lessons won't earn you $10. Reviewing 10 of your own trades carefully can actually change next month. 5 must-haves in a solid journal. Entry time and price, exact, e.g. 2:30 p.m., entry to a 42,500, entry reason in 1 or 2 lines. What signal did you see? Target stop. Include the stop loss in 2, outcome, and exit time. Especially flesh out number 2, the entry reason. Candles look good is not analysis. Something like daily, touch under a key moving average, then trend recovery. 4-hour, support holding above the MA. Long entry, that is analysis. Read it a week later and you'll see one of 2 things. I broke my rules, emotional entry, or I followed the rules exactly and still lost. The rules themselves are weaker. The first is a discipline problem. The second is a system upgrade signal. Both are useful learning. The point is you can objectively judge, did I follow the rules this time or not? Bad review example. Why did I sell? Dunno, got nervous. Next time, I'll hold longer. Too vague. It never turns into a behavior change. Good review example. February 15th, 2:30 p.m., entry 43,200. Bounce off support per rules. Target 44,500. At 6:15 p.m., as the rally slowed, I emotionally sold half at 43,800. But the rules only define stop and target. An hour later, it hit 44,800. Come on from now on. No exits except stop or target. A good review, exact time and price, clear on whether you follow the rules, connects result to lesson, writes the next action in concrete terms. You're not just reviewing one trade. You're evolving your trading rules one step at a time. The moment you make the same mistake twice, it's no longer a mistake. It's a habit. Match the review rhythm to your trading size. If you trade daily, Log 3 to 5 trades each evening between 9 o'clock and 9:05 p.m. If you trade 2 or 3 times a week, spend 20 minutes Sunday at 9 p.m. and dig into last week's 5 trades. At month end, last weekday evening, scan the past 30 days and ask, what mistake pattern did I repeat most this month? Usually 2 or 3 jump out. Put those at the top of next month's checklist. Quarterly, every 3 months, write how your rules system changed. Something like, in January, I only watched moving averages. By March, I also confirmed support and resistance. That's your growth story. Same way traders refine how they read the S&P 500 or Nasdaq over a Fed cycle. Mixing short, daily, medium, weekly, and long, monthly/quarterly scales lets you catch both fleeting emotion and solid patterns. Rules harden and evolve faster. Lesson 39 wrap. The brain lies. Journal right after the trade patterns only show up deep in a record review is not about feelings. It's the tool that evolves your rules. Support and resistance, candle reading, risk management from the last 5 lessons. For all of that to actually work on a live chart, you need the verification loop of journaling and review. Theory becomes habit. Habit becomes results. Next up, track T 4 goes 1 level higher. We move from trading by feel to trading proved by numbers, expected value, back tests, and capital management simulations. Your trading becomes a science. If this helped, hit subscribe and like, and share your own review stories in the comments. 1. I found this pattern note can spark someone else's growth. This lesson is for education only and is absolutely not investment advice. You alone are responsible for every trade and every loss.